Now, all that being said, let's get right into it. The question I mentioned that came in via email right before the webinar is from Gregg M. And this is related to the Married Put discussion and the 12 different income methods. Buying a stock, buying a put option far out in time to control risk to 5 or 6%. But now we're in a position. Gregg asks, I'm wondering if you can address the downside or timing of taking profit on the put position as the stock's fallen, or rolling down the put to get some money off the put position, lower the overall cost basis in the trade. I don't want to lose that profit if the stock starts heading up again. But if I roll the put and take the profit and the stock starts heading up, I'll be forced to pay to roll it back up. It's another income method. Is one way or the other more economical? Roll it and take the profit, followed by paying to roll it up again, or instead just leave it alone? So this refers to income method number 9 in the blueprint, the full course on the Married Put position, radioactive trading, as well as income method number 4, rolling up the put, which I did 2 of this week on my positions in the Fusion portfolio at radioactivetrading.com. Now, a little bit more, Gregg goes on to say, I intend to keep the stock for now as it's sitting on long-term support. If the support breaks, I'll sell the stock and let the put ride, or add an additional put. I know you discussed something like this not too long ago. I'm still unsure of the best practices. I took screen clips of the existing positions. So the position in question is listed back in 2000, I think it was. Gregg has 400 shares of UNH at $114.17 cost basis total. Current stock price is $455.74. So it's about a 300% profit on this position. Now, I'm sorry, it's about 280, or I can't remember. We'll take a look at that in a moment. My apologies. Now, he owns 4 contracts of the June 520 put that he paid $23.04 for. This was back on February 14th, when the stock was closer to 520. So now the stock's pulled back to 455. That 520 is worth a lot more money now. Of course, the stock has fallen from its highs of where it was. Now let's go ahead and navigate over to Power Options, and let's take a look at this position a little bit more in depth, see what we might consider, and see some concepts that he was referring to regarding, should I just leave it alone and wait for the stock to come back up if that's my goal? Should I take the profit on the put in the Married Put position now, but will it cost more when I roll it back up? All right, let's go ahead and take a look here. I'm going to navigate over to the Power Options suite of tools. And of course, we're just looking at the basic main view with this tab navigation system to our various strategies that I've selected. Here's the pods that I mentioned a little while ago, the watch list, of course, the market sentiment drifting back to neutral after the easing off of the pressure valves a little bit yesterday. We were at sell warnings, but after that decline yesterday, we sort of had an easing of some of those indicators, but I won't be surprised if we get an update for April 5th, if we'll be heading back into possibly a sell warning or starting to see a few more bearish positions or bearish indicators. We'll talk about that later when it updates. Oh, and that trade picks that I mentioned in the opening discussion, here's the quick view of the trade picks of the day for weekly and monthly expirations for covered calls, naked puts, bull put credit spreads, and long calls as well. But for Gregg's question, let's jump right into the portfolio. And I entered Gregg's position into the portfolio tool as a married put, as a linked position. So we have one married put where the position is linked together. I've selected the stock analysis view here, the tab view feature. You also have a Greek's view, important dates coming up, and options related details of the different options in your portfolio. But this is tracked as a linked position, and why I selected that stock analysis view here is because it adds these 6 extra columns over here on the right that you don't see in the standard view. And the 6 extra columns, of course, we've got the total position cost with his underlying cost basis of 114.17 for the UNH stock and the put at 23.04, but remember it's 400 shares. The total cost basis is 54,884. And right now the liquidation value of the stock and the put at 63.88 is 207,846. So the profit on the whole married put position as it stands right now with his cost basis is 278.7%. Now, I bring that up because a lot of times investors will say, well, why are you buying the put to begin with? Why are you insuring the stock if you're so bullish on it? You're adding to the cost base. You're going to need a much bigger move in order to see a profit. And we always say that, well, in the married put by itself, even if I don't do the income methods, we're expecting to still see 50 to 60% of the gain in the underlying stock due to the delta of the put, which is probably a 0.6, 0.55. But once you get into a vast increase, this is probably more than I have in my portfolio in any one position right now. But when you get into this increase, once it starts moving above a 20 to 25% profit, you're realizing more and more of that unrealized profit on the position naturally because the delta on the put is getting lower and lower. That's initially, I just wanted to illustrate that the stock's up 299% with adjustments that Gregg has made over the years. He's still making 278%. And of course, as you saw in that one graph on the profit and loss chart, it is a bulletproof position, meaning the worst thing that can happen is that he's only going to make about $153,000 of it if I enter this position, which I enter this position correctly. Okay, so that's where we have that. I just wanted to point that out real quick. But what are we talking about today? He's got an unrealized profit of $40.84 in the put. It's one of the advantages of the married put structure. If I first entered the trade new, we'll take a look at some of those. You'll start off with only a risk of 4, 5, or 6%, maybe 7% on the position. If you enter the wrong stock and it falls 15 to 20%, the most you can lose is that 5 or 6 or 7%. And if it goes up 20% or even 10%, you're still going to be realizing, 5, 6, or 7% with a 10% move. It moves up 20%, you're going to be closer to 15, 16, or 17% without using any other adjustments in the position. That's the structure of the basic married put trade. But now the dilemma. Is it better to take the profit off this put now, lower it down to a different strike price to still keep some locked-in profit, guaranteed profit, and a bulletproof position in place, or just leave it as is and wait for the stock to recover? First things first, when I look to do this quote-unquote income method number 9, one of the 12, really 13 different income methods discussed in the blueprint, this is the reference that he was referring to earlier. What I typically look for, it was a video from a few weeks ago. What I typically look for is something like this. Something where we're seeing a bottom on the MACD and the stock's coming up, or we've broken the lower Bollinger Band, but we're moving back up towards the SMA 20. Now, I'm not quite seeing it here. Okay, there's this big gap down. Ernie had a coaching session related with this week as well. I can't remember the gentleman's name. I think it might have been Mandeep R. But what I'm typically waiting for when I do this adjustment is when I start to see a bottom here and I start to see a trend moving back up towards that SMA 20 or SMA 50, bouncing off and above the lower Bollinger Band and a base being set in the MACD, for example. Because what you want to try to do, and Gregg had mentioned that he feels like it's hitting this base support now at this point. If it goes lower, he's going to do a different plan. But right now, if he thinks he's at base support, is this the time to do it? Well, these are my thoughts when I look to do income method number 9, Gregg. That's what I typically look for. That was discussed in the previous presentation that you referenced. And also when we would look to roll up the put to the higher strike prices, which one might take a look at as well in those positions. So where are we going here? Let's talk about it. Gregg also mentioned he's got the idea to roll down to a specific put that came up from our rollout opportunities. So as I'm tracking a position in the PowerOptions portfolio, we can use the Edit More Information button here, as we did before, to link to the stock chart. We can link to the profit and loss chart as well. But I want to go to Position Actions and then Position Analysis. This gives us that breakdown of our current position. The true max risk here is guaranteed profit of 382.79 or 279%. Stock's up about 299 as we saw. Current liquidation is about the same as it would be if we held this for the next 77 days and UNH remained below 520. We're pretty much at the maximum loss on this position, which is a guaranteed profit of 279. But the thought process here is that Gregg wants to continue the trade, and he wants to continue it with the put in place to continue to have the guaranteed profit locked in place and continue to make adjustments and manipulate the position. So we know what our return is now. We know what our return would be at expiration, essentially. And then we see some of the available rollout opportunities. Now, we could roll the put closer in. That's income method number 3. We're not going to look at that. And this one came up with a bear call. I think I did something wrong. I apologize for that. I think I see what I did wrong here. Give me 1 second. What I'm going to do is go back. His rollouts were different because his position was entered more correctly, meaning that when he entered the put option, he had put in the proper price where the stock was at the time of the trade. So let me adjust that. That's why we're not seeing those income method number 9s. They didn't have a chance to actually review his rollout opportunities before we started the webinar. So let's just try that again, shall we? And let's go to position actions and position analysis now. I'm still seeing the same thing. Okay. Any case, the role that he was looking at, with the stock now trading, there we go, with the stock now trading at 455.74, he's considering rolling a little bit further out in time to give more time into the trade, which is the first thing I would recommend. This put is pretty much near intrinsic value. We saw that cost of about 68, and the put is roughly $67, $68 in the money. So there's a small amount of time value left, only about $3. In the last 60 days, it's really going to start to pan out. So let's go ahead and take a look. If we sold the June 520 now, I'm sorry, yeah, it's about going to be at about 63 midpoint price up to the 520. I think it's actually going to be closer to the selling to close it. The intrinsic value is closer to 65. But in any case, let's just go ahead and simulate selling to close this. What does that do to our position? You had a cost basis of 114.17. Okay, plus the put of 23.04. But now we're going to sell that. Let's just call it, 63.87. And that's going to lower your cost basis down on the position by that extra $40. You're almost going to have $70 in cost basis. So we take it's $40 almost even. It's about $40.80. Let's just call it 40.87. So you're going to lower the cost basis on the position down by that amount. So instead of having a cost basis on the stock now on per 100 shares of 114.17, and we're going to take off that roughly $40.80. Let's just call it 40.85. Your new effective cost per share on the stock is going to be 73.32. So what I want to do is actually adjust that here in this case, Greg. Since I didn't see it in the rollout opportunities, we're going to clear out these two puts. We're going to take the profit on your put by putting the stock at 73.32. And your example, I think, was going out to August using the 460 put, which is almost at the same initial price you paid, at that $23. What is this going to do to your position? Well, now you've got a locked-in profit here roughly of about 256. Why did that decrease percentage-wise from when we were at 270? We lowered the put down 60 points. Remember, we were at the 520 strike. We lowered this protection down to 460. All right, so we're getting $60 less of a guaranteed exit on our position than we had before. We collected a premium to do that. We lowered the cost basis down roughly by that $40.85. So the cost basis of the total position dropped to $40.85, but our guaranteed exit here is $60 less. That's why this return is actually lower. But now I'm at a position where I'm closer to at the money. I've also extended the time almost 60 days to have more time in the trade and less effect of any remaining time decay, that only $3 or so that was on the position, to work against me. It's really right at the money. I mean, right at intrinsic value. I apologize. So that's the effect of the position. We've lowered our cost. You've pocketed the profit to lower your stock cost down to 73.32. You still have very high guaranteed exit, but now you're concerned about, what if the stock starts moving back up to 470 and 480 and I have to pay $20 to roll this position back up? Remember, you already took in 40. You've lowered your cost basis by 40. You lowered the protection. If you have to roll up to, let's say, the 480 later on, it's probably only going to cost you $10, $11, or $12 to increase the return by $20. The guaranteed exit, that is, by $20. That still works in your benefit because of the high profit you're taking out of this put now that it's at the bottom. In my experience, Greg, and I don't have thousands of statistics on this of the right, I don't want to say the right timing, of, if I had done this instead of not doing this, if I had have worked this instead of not doing this. But in my experience, when I get the trend right that I'm looking for, and I think the stock has bottomed and is starting to move back up, and I see the potential movement upwards based on the trends I was looking for, when I do 9 in this area and then I come back and use 4 in this area, my risk is still lower up here than it was before with the initial put position. That's been my raw experience. Now, we do take the chance, of course, right? We roll down here. The stock starts to move back up. We roll back up again. Yes, we're adding back to our cost basis, but our risk was lower. We took profit off of the put here. We added some back in up here. We still have a low risk position, and then oops, something like this happens again. Well, now I have the chance to work that cycle over. We're manipulating the second working asset in our arsenal. The put, protecting the position, is not just a wasting asset. It is a second working asset that can be manipulated, as Gregg mentioned. And that's what we're looking to do. A quick example. Let's go over to radioactivetrading.com. And I'm going to go into the track record here real quick. There was one I looked up earlier. Now, you can only see the full track record if you're a subscriber to Fusion at radioactivetrading.com. And it's the SBUX position here. 9.2% return, 97 days into the position. Now, we originally opened the position on June 7th, 2022. I bought the stock at $78.89 and bought a November 80 put for $7.75. So when we post a trade in the Fusion portfolio, following the rules for the Married Put approach discussed in the blueprint, both Ernie and I post our trades here, you have the full layer here. We have a risk of 7.7% to start this Married Put position. 10 days later, some awkward news came out. Remember, we got in at $78.89. 10 days later, the stock's at $71.32. I said I missed an opportunity for income method number 12. That's that extra put that Gregg was referring to, done in the proper fashion. But now that this drop has occurred, we've rolled down the put. I sold the November 80 at $12.32. And yeah, I sneaked this in a little bit 1 month to the September 75, the next lower strike price. So you see here, my total cost was a little bit less than $5 because I also moved in closer in time by 30 days. But we still lowered the put down to 75, which still increased the risk on the position. Why? Because I got a credit of about $5 for this transaction, a little bit less than $5 for this transaction, but I lowered the protection by 5 points, so my risk increased. And 7 days later, the stock moved back up, was trading right at around 78, I believe, at that time. So we rolled up with income method number 4. We were able to sell to close our put for $435 that we paid $755 for. We bought a new put at $685 at the higher strike. We paid $250 to gain 5 points. And this dropped the risk down to 5.2%. So where did we start? We started with a risk of 7.7%. We did this roll down that you mentioned. We increased the risk slightly. Then we rolled back up with income method number 4, and now the risk is 5.2%. Essentially holding the same put that we started with at the 80 strike. Yes, we shortened it by 30 days in that scenario, but we were able to manage it in that position. Other examples that I've seen Ernie use in his portfolio, with the Ernie at PowerOptions Portfolio in mine, when timed right, when you do the 9 to lower the cost basis on the position, and then the stock recovers and you roll back up to 4, I typically see the lower risk, or in your case would be a higher guaranteed profit on the position if later on I moved back up to the 480 put and only paid $12, $11, or $10 for the position, for the debit to roll back in, because I've already taken the 40 out on the profit on that put and moved my cost basis down to 73.32. Yes, by rolling back up, if the stock recovers as you're expecting, you're going to do it a debit. You're going to add to the cost. It might not be $40. It might only be 15. It might only be 20. It might only be 12. But remember, when you roll up in that fashion, if you're keeping the same expiration date, that is, you're always getting more of a guaranteed payout than what you're paying into the position. And you can factor in the fact that you took that $40 profit that we saw on your initial put that you have right now, the June 520 put with 77 days to expiration, the $40.84, $40.85 or so of profit that you have in the position. So again, when do we look to do it? That was what was discussed in that other webinar we talked about, taking the profit off of the puts. Yeah, we look for the bottom. I typically use a combination of coming back up above the Bollinger Band, maybe getting closer to the 20-day moving average after a breakdown, and getting closer to these sort of trends that we want to see. These sort of switchovers where we're going back up. Not to say that it's a bad time, because I haven't tracked UNH. I don't know its history. I don't know why the decline happened. I know Ernie discussed that, as I mentioned, on a coaching session this week with another Power Options member. However, that being said, I would look for maybe something a little bit more concrete coming up back above the Bollinger Bands, a more smoothed out or bottomed MACD in these cases. Not necessarily seeing the positive crossover, but I'd really like to see that in that case, to see that the trend has changed and we are at that point. Maybe I miss a little bit here. In this case, maybe I missed a little bit here, but that's kind of okay because I want more of that stability there. But hey, sometimes this still happens, but it didn't matter because I was either bulletproof to begin with or had a guaranteed low risk position in place at the start. And that's when we look to do it. That's when we look to use the income method number 9. But per my experience, per your previous question and your question in general, as we mentioned, you're looking to continue the trade, keep the stock now as it's sitting on long-term support. Best practices and what you discussed before, you're going to be forced to pay to roll it back up in those cases. But every time, Greg, I've picked it right. Every time I've done it where the stock didn't continue to move down and then I scrambled to buy an extra put to turn that increase in potential risk into a profit on the position, did that a few times. But when I roll down with 9 and I'm right, and then I roll back up with 4 later on, it usually is a lower risk, or in your case, a similar higher guaranteed profit with the bulletproof status. That's been my experience. Each situation is a little bit different. You know, you're taking $40 of profit off of this put, almost $41 of profit off of this put. If you start moving it back up in stages, well, you might pay $11 the next time you roll it up if you move it up 20 points. And if you only move it up 5 points, you might be paying $2.50, $2.60, or $2.70. You roll it up 10 points, you might be paying $5, $5.50, or $6. That's what's in the blueprint discussing when to use income method number 4. But this pattern And I think there's an example of this, an older example of this in the blueprint in the appendix that shows the full construct of one of Ernie's first RPMs. I believe it was IBM, if I'm not mistaken, where he walks through. He did have different times where he rolled down with income method number 9 and then back up with income method number 4. And you can see how the benefits, when done correctly, were outweighed by the fear of adding the additional cost after it drops down. You're planning on staying in this position. You're expecting UNH to recover at some point or another, whether it's 30 days away, whether it's 60 days away. I would like to see if your roll that you mentioned going out to that September that was 133 days away from now, from today, adding about 60 days to your position, that's 77 days to expiration. But in general, as you know, we like to go out 150 days or more following the rules in the blueprint, those 3 core principles. I might like to see this roll out farther, especially since you're planning on staying in the position. Will you pay more for the longer term put? Yes. Will you still lower your cost basis? Yes, but maybe not as much as you showed with going down to the September put option down to that 460 strike. However, you're still going to have a high locked in profit. And when you roll back up, I think it's still going to be beneficial to you. You're still going to have the advantage there of what we saw in that sort of SBUX position, Greg, where my expectation and what I've seen in the past is the expectation that when you roll back up, you'll have a lower risk than you initially started with, even if I'm keeping the same strikes and the same expiration. That being said, there's a possibility it could be a wash. I've seen that happen too. If I'd stayed in that SBUX position, let me just go back real quick. The SBUX position that I referred to, that older trade from 2022, not really that old, if I had kept the November series here, I might have collected about $2.50, $2.60, maybe closer to $3 actually, to roll down the put. The 75 strike for November, not September. Then I might have paid another $2.60 or $2.50 as we did here, $2.50 even, to roll back up. So at that point, it's almost a wash. I'd be at almost the same exact place with the risk factor. I'd still be at about 7.7% risk. But a lot of times, as I mentioned, when you pick it right, you get close to near the bottom. You know the UNH stock, you know the support levels you're looking for. If you get it as close to the bottom or near the bottom, even within 4 or 5 points, a larger stock like this, maybe even 8 or 9 points, maybe even 10 points, when the stock starts to move back up, you're still going to get the benefit of that because you're locking in most of the profit on the put now. This put's probably the highest price it has been since you got into it, as you mentioned, because it looks like it's had this big drop and now it's starting to hold. To be confident, I'd like to see a little bit more strength. We know we've had some hiccups in the market this week, in the past few weeks actually, after our strong run. So I might want to see a little bit more indicators of confidence moving forward in that case before doing income method number 9, just to make sure, even though I'm not getting what I'd call quote unquote, or might not even be quote unquote, the maximum profit on the put right now, I might wait a little bit on that. Okay. But those are my thoughts. What we look for the timing, the fact that for my experience, since I've been trading this technique in 2008 with about 50 to 60% of my total portfolio, when I've done the 9s and the stocks recovered and I move back up with the 4s, the benefit of lowering the cost basis, even though the risk increased slightly, and then moving up afterwards, still gave me a lower risk, still got me to bulletproof status. Now, the SBUX is just one example, as I mentioned. Ernie has one, and I'm pretty sure in the blueprint that illustrates this. We've got other ones in the track record at the Fusion portfolio. It's done as well. Of course, that full discussion is, you can see more information about that on the Married Put tab, but the blueprint is the full course that discusses the initial setup, the proper setup, and the use of all 12 of those different income methods. The details, even a little bit more than what we went in today about looking to roll down the put with that income method number 9, the risks of rolling down the put with that income method number 9, and also the benefit of rolling up with income method number 4 when the stock's moving in your direction. We could show an example of that because we did 2 of those this week, as I mentioned, but also, of course, when, how, and when not to use those income methods. That's what's discussed in the full course. It's all electronic. you'd access it at our educational portal, learn.poweropt.com. So that's the full course, but you can see some basic concepts and information here in the Married Put tab on Power Options. Down here in the Learning Center, the 4-part article that Ernie wrote. The sketch is a free 9-page white paper that introduces the concepts and the income methods as well. But the full course is only available in that blueprint there. The electronic copy that's available, you'll access, on our educational portal, learn.poweropt.com.